This is unbelievable, and I don't say that lightly. I say it because what is building beneath the surface of the silver market right now is the kind of pressure that history warns us about. The kind that doesn't move slowly and politely, but the kind that snaps, the kind that shocks, the kind that forces the world to reprice reality in a matter of days. Right now, silver is in structural shortage. Not a rumor, not a conspiracy, not a temporary hiccup in logistics. A structural shortage. That means the world is consuming more silver than it is producing, year after year, quietly, relentlessly. And that gap isn't shrinking, it's widening. Industrial demand is not slowing down. It's accelerating. New battery technologies are being rolled out that require more silver per unit than previous generations. Solar technology continues to evolve, and each new generation often increases silver intensity because efficiency improvements demand higher conductivity and reliability. Electrification across the globe is no longer theoretical. It is policy. It is infrastructure. It is mandate. And silver is embedded in all of it. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Unlike many commodities, silver is not just a store of value. It is a critical industrial input. It is used in electronics, energy systems, medical applications, defense technology, advanced communications, and next-generation infrastructure. In many of these applications, it cannot simply be substituted without sacrificing performance. That matters. Because when a commodity becomes both an industrial necessity and a monetary hedge at the same time, you get tension. And tension in markets eventually resolves through price. Now here is where it gets even more serious. The physical market is tightening while paper markets still dominate price discovery. Futures contracts trade massive volumes compared to the actual available physical metal. For decades, this wasn't an issue because most participants treated futures as financial instruments, not delivery mechanisms. They speculated. They hedged. They rolled contracts forward. Physical delivery was rare. But that behavior is shifting. More participants are demanding physical settlement. More contracts are standing for delivery. And when more people ask for real metal instead of paper settlement, the system feels strain. Because the leverage in futures markets assumes most people won't ask for the metal, if that assumption fails, even temporarily, volatility explodes. We've seen glimpses of this dynamic in other commodities. Extreme short squeezes, sudden price spikes, exchange rule changes, margin requirement increases, trading halts, contract cancellations. These are not theoretical possibilities. They are documented events in modern markets. And here's the part that should make you pay attention this week. When exchanges sense stress, they often raise margin requirements. That forces leveraged traders to liquidate positions. That liquidation can temporarily smash prices downward, even if fundamentals remain bullish. To the outside observer, it looks like collapse. In reality, it's often forced deleveraging. This is how markets create confusion. A long-term shortage can coexist with a short-term crash. That contradiction drives people insane, because in the moment, price feels like truth. But price in the short term is often liquidity-driven, not reality-driven. Silver is volatile. It always has been. It moves fast. It overshoots. It punishes emotional traders. If you attempt to trade in and out of silver based on headlines, you will exhaust yourself. Your stress will spike. Your conviction will evaporate, and you'll likely sell at the wrong time. But step back. 2 years from now, the violent moves of this week will likely look like small squiggles on a chart, tiny blips in a larger trend. That is how bull markets behave. They advance in waves, powerful rallies followed by sharp corrections. Each correction feels catastrophic while it's happening. It rarely is. Now consider the industrial side again. If you are running a factory that produces electric vehicles, solar modules, defense systems, or advanced electronics, silver is not optional. It is an input. And when you require an input to prevent billions in losses from halted production, price becomes secondary to availability. If the choice is between paying significantly more for silver or shutting down operations, you pay more. That dynamic is what transforms tight supply into panic buying. Panic buying is not about speculation. It is about survival. And panic buying changes price discovery instantly. There is also the global macro backdrop. Monetary systems are strained. Debt levels worldwide remain historically elevated. Geopolitical tensions persist. Trade realignments are ongoing. In uncertain environments, precious metals attract capital. That demand overlays industrial demand. So you have two forces converging: industrial necessity, monetary hedging. That convergence is rare. and powerful. Short-term drops do not invalidate long-term trends. Corrections are part of bull markets. Profit-taking is normal. Speculators exit. Weak hands sell. Strong hands accumulate. The question is not whether silver will move. The question is how violent those moves become when physical constraints meet financial leverage. And this week matters because temporary factors can distort perception. Holidays in major trading regions can reduce liquidity. When liquidity thins, price becomes easier to push around. Large players can exert outsized influence. That can exaggerate declines. But when global participants return and physical demand resumes at full force, distortions can reverse just as quickly. This is why understanding fundamentals protects you psychologically. If you know the world is consuming more silver than it produces, then temporary price weakness becomes context, not catastrophe. If you understand that futures markets can be gamed in the short term but cannot manufacture physical metal in the long term, you remain grounded. There is also an uncomfortable reality about modern markets. Authorities intervene. Exchanges change rules. Contracts are modified. Settlements shift. History shows that when systemic stress emerges, rulebooks become flexible. That is not cynicism, that is observation. Which means betting everything on a dramatic collapse scenario is reckless. But ignoring structural shortages is equally reckless. The rational path is disciplined exposure, gradual accumulation, dollar cost averaging, avoiding leverage, focusing on quality instruments, owning some physical metal if appropriate, considering diversified vehicles tied to the sector, not gambling, positioning. Because the real story here is not about a single explosive prediction. It is about a tightening system that cannot remain imbalanced forever. Silver deficits compound over time. Each year of underproduction reduces above-ground inventories. Each year of industrial expansion increases baseline demand. At some point, inventories reach levels that trigger aggressive restocking. And when that switch flips, price does not ask for permission. But here is the crucial mindset shift. You cannot control timing. You cannot predict the exact week, the exact spike, the exact catalyst. What you can control is preparation. Volatility will test you. Headlines will test you. Sharp drops will test you. Explosive rallies will tempt you to chase. If you attempt to outsmart every move, silver will wear you down. If instead you recognize the long-term imbalance and structure your exposure calmly, you reduce stress. And that matters more than people realize. Money is supposed to reduce stress, not create it. Your sleep is more valuable than any short-term trade. If markets become chaotic, and they might, those who are over-leveraged will panic. Those who are positioned thoughtfully will observe. And remember, even if shortages intensify, even if exchanges experience strain, governments and institutions may intervene in unpredictable ways. That uncertainty is precisely why discipline matters more than excitement. This week could look dramatic, it could look messy, it could look confusing, but confusion does not change fundamentals. Silver supply is tight, industrial demand is growing, financial interest is rising, leverage is embedded in paper markets, and physical inventories are not infinite. That combination is combustible. You don't need to predict fireworks to acknowledge that dry tinder exists. The unbelievable part is not that silver might move. The unbelievable part is how few people are paying attention to the structural imbalance building beneath their feet. And when markets finally force attention, they rarely do so gently. Now let's go deeper, because surface-level analysis does not capture the magnitude of what may be forming. When a commodity enters persistent deficit, the first stage is quiet drawdown. Inventories decline slowly. Reports note tightening conditions, but nothing breaks. Prices may rise, but they remain manageable. Market participants assume supply will respond. But what if supply cannot respond quickly? Silver mining is complex. Most silver is not produced from primary silver mines. It is often a byproduct of mining other metals. That means increasing silver output frequently depends on increasing production of entirely different commodities. It is not as simple as flipping a switch and mining more silver. New mines take years to permit, finance, and develop. Environmental regulations, geopolitical risks, capital constraints, all slow expansion. So when deficits persist, production cannot instantly scale. That creates vulnerability. Meanwhile, industrial users operate on production schedules measured in months, not years. If they anticipate tightening supply, they begin securing contracts earlier. If they fear disruption, they overorder. If competitors start stockpiling, no one wants to be last in line. This is how normal demand becomes accelerated demand. And once accelerated demand begins, it feeds on itself. Financial markets then notice. Traders front-run anticipated shortages. Speculators increase exposure. Momentum builds. Media coverage amplifies the move. Retail participants rush in. That is when volatility becomes extreme. But here's the paradox. Even in the face of genuine shortages, prices can fall sharply before they rise dramatically. Why? Because leveraged markets exaggerate both directions. When margin requirements rise or liquidity shrinks, forced selling hits fast. Algorithms react. Stop losses trigger. Momentum flips negative. Fear replaces optimism. The uninformed see collapse. The prepared see opportunity. Yet preparation does not mean blind optimism. It means acknowledging risk. Because if futures markets face stress and opt for cash settlement over physical delivery, trust can erode. Even if legally permissible, the perception of default changes behavior. Trust is the foundation of paper markets. If participants begin doubting whether contracts truly represent deliverable metal, they adjust strategies. They demand premiums for physical. They reduce reliance on derivatives. They shift to direct ownership. That migration alone can tighten supply further. And if industrial users begin competing directly with investors for limited physical inventories, price becomes secondary. This is when markets enter nonlinear territory. Nonlinear markets do not move in predictable increments. They gap. They spike. They retrace violently. They exhaust participants emotionally. Which brings us back to psychology. The greatest risk in volatile commodities is not price fluctuation. It is emotional mismanagement. People buy aggressively at peaks because momentum feels safe. They sell at lows because fear feels protective. They overallocate after rallies and abandon positions after corrections. Silver magnifies those tendencies because its swings are large relative to many other assets. If you attempt short-term precision, you are competing against institutions with faster information, deeper capital, and algorithmic execution. That is not a fair fight. But long-term positioning is different. If structural deficits persist, if electrification continues, if monetary uncertainty remains elevated, then the macro backdrop supports higher long-term pricing. That does not mean straight lines upward. It means upward bias over time. The scenario that creates explosive upside would likely involve a combination of factors: accelerating industrial demand, visible inventory depletion, increased physical delivery requests, and a catalyst that shakes confidence in paper settlement. That catalyst could be geopolitical tension. It could be a supply disruption. It could be financial stress. It could be policy miscalculation. No one knows. But markets often reprice suddenly when multiple stressors converge. We must also consider government behavior. Strategic reserves, regulatory changes, market interventions, all are possible. Authorities may attempt to stabilize prices if volatility threatens industrial stability. They may alter trading rules. They may inject liquidity. Intervention can suppress price temporarily. It cannot create metal. Physical constraints eventually dominate. History shows that commodity bull markets feel absurd at extremes. Prices reach levels previously considered impossible. Commentators mock predictions, until they don't. At the same time, apocalyptic forecasts often overshoot reality. Not every shortage leads to systemic collapse. Not every spike sustains. Balance is critical. Expect volatility. Expect interventions. Expect corrections. Expect overreactions. But also recognize structural arithmetic. If annual demand exceeds annual supply, inventories decline. When inventories decline far enough, restocking becomes urgent. When restocking becomes urgent, price elasticity shrinks. In such environments, even modest incremental demand shocks can produce outsized price moves. This is why patience matters. It is easy to get caught in daily narratives. Exchange inventories, regional holidays, margin adjustments, short-term speculation. These factors matter in the short run. They do not redefine structural imbalance. 2 years from now, this week may indeed look like a minor oscillation within a broader uptrend. Or it may mark the beginning of heightened volatility that forces global attention back onto silver as both industrial backbone and monetary hedge. Either way, reacting impulsively is dangerous. Preparation is not excitement. Discipline is not passivity. Positioning is not gambling. It is entirely possible that prices rise significantly over the next decade without dramatic collapse. It is also possible that acute stress produces rapid repricing events along the way. The responsible approach acknowledges both. Gradual accumulation. Diversification within the sector. Avoiding excessive leverage. Maintaining liquidity. Protecting mental and physical health. Because if markets become chaotic, clarity will be rare. Those who maintain balance will navigate better than those chasing headlines. The unbelievable part is not just the shortage. It is the convergence of industrial transformation, monetary uncertainty, leveraged financial structures, and shrinking physical buffers, all intersecting in one metal. Silver sits at the crossroads of technology and trust. Technology demands it. Uncertainty attracts capital toward it. Financial systems price it. Physical realities constrain it. When those four forces interact under stress, the result is rarely calm. So what's about to hit silver this week? Possibly nothing dramatic. Possibly violent swings. Possibly forced liquidations. Possibly renewed accumulation when global participants re-engage. But beneath the noise, the larger narrative continues to build. And narratives built on arithmetic, not hype, tend to assert themselves eventually. So stay focused, stay disciplined, and understand the difference between short-term chaos and long-term imbalance. Silver does not need hype to move. It needs pressure, and that pressure is building. Whether this week becomes a footnote or a turning point, the structural forces are real. Prepare intelligently, manage your risk, protect your peace of mind, and remember, markets reward patience far more often than they reward panic.